Good evening, everybody. Welcome back. We've had an interesting week behind us, probably an interesting one still to go, to be honest. But, you know, there's a lot of volatility in foreign exchange markets. And I wanted to sort of discuss what's going on in sterling, particularly at the moment, because the UK really is facing some pretty major problems, probably as many as anybody out there, to be honest. And we need to sort of take a look at what's going on behind the scenes and look at the fundamental structures behind what could move sterling from here. Now, Liz Truss is the new Prime Minister. She's taking over something that looks like a bit of a poisoned chalice, to be honest, because the economy is in its worst state since the 1970s, and there's no getting away from that, to be honest. Issues have been stucking out against the UK for a while. We've been mentioning it here week after week. There seems to be quite a few things coming to a head. You know, you can see on the right, the UK economy stagnated in the 3 months to July after that very good rebound after COVID. It's really starting to roll over again. Doesn't look great looking forward. And even we've had the central bank telling us things are going to get worse. So Monday's GDP showed data in the economy flatlining at best, I would say, and that's fairly backward-looking data, don't forget. And there is certainly a cost of living crisis hitting the consumer from all sides. So we've got higher interest rates, higher prices, higher gas prices, just about everything that's essential. The consumer's getting hit with higher prices. So inflation, well, what can I say about inflation? Someone said it's eased to 9.9%. Well, yeah, okay. Well, the Bank of England is looking for higher. I think it probably still does go higher, but there are some issues with consumers at the moment, balking at higher prices, not spending so much on what they want rather than what they need. So this CPI 9.9%. We're up from 10.1, but even the central bank is actually suggesting higher rates of inflation going forward. So, the following data, the Bank of England meeting was postponed from last week to next week. Be interesting to see what they have to say, but we do have some real recession alerts going on in the UK. The composite PMI, as you can see here, moving down towards this level of 50. Anything below 50 is contraction. Doesn't look great. Forward-looking, companies are worried about margins. I think earnings in the UK, forget the FTSE 100, which is not a fair reflection of the UK economy, but look at the FTSE 250 and below, and they've had a pretty torrid time. I mean, down 21, 22%. So not looking great there. We've got business activity falling as well. Bank of England, Bailey suggests, it's surprising, actually. We don't often hear the truth as clearly put as Bailey has put it, looking for a winter or possible recession coming in Q4, possibly higher inflation still to come. This is honesty and pragmatism we don't often get from central bankers. So, some of this can be self-fulfilling as well. So there's danger here that the consumer is really sort of suffering, and we may see a real breakdown in spending and consumer sentiment, which is already the case that we have in many places. But this labour unrest at the moment, we've got strikes building, we've got wage demands because of the cost of living process. This strike action could go on through the winter. It's not looking great, to be honest. So, there's a lot in the background that's bubbling away that we know about. This is evidential. We can, if we look, we can find this stuff, and it does sort of put out a pretty bleak picture. However, sterling has moved quite a lot already this year, but UK assets are feeling rather unloved at the moment. What worries me about what's going on in the UK at the moment is there could be some international disinvestment from the UK. It seems to me that with the fact that bond yields are going up, so UK bonds are going down, the prices are going down, yields are going up, bonds are going down, the currency's going down, and yet they're raising rates and the currency still can't rally. Now that sounds like disinvestment to me. So just about everything, so stocks, bonds, and the currency going down at one time suggests big funds are pulling money out of the UK and depositing it elsewhere, and possibly in the US, which seems to be the best of a bad bunch at the moment. But you can see this 15% fall in sterling has actually priced in some of this weakness that's actually there in the economy. The question is, how much weaker can the economy get, and how much further could sterling go? Now, we have had a very small rally today, but we haven't broken above the 38% retracement level yet on sterling against the dollar. Euro sterling sits at the top of its 2022 range, and sterling has weakened over 3% against the euro. Sterling is not particularly loved at the moment, but there are some subtle reasons why. And to be honest, more problems for the BOE to deal with. How do they balance this weak growth with higher interest, with higher inflation going forward? And we've seen bond gilts, as they're known as, really getting hammered pretty hard. So this is forcing bond yields higher, but not yet supporting sterling. And this is a concern. And you've had a pretty awful August. I mean, the pound has gone down. I think it's its worst month since 2016. And, gilts posted their biggest loss on record. So these yield spikes are really interesting. Now, with the Fed looking like they're doing 75 basis points at the next meeting, we've had the ECB doing the same. What does this mean for the Bank of England going forward? Are they going to have to sort of catch up a bit? So the UK is really, really suffering at the moment. And the Bank of England has one of the toughest jobs out there. And UK stocks have had a really mixed performance because the FTSE 100 or the UK 100 is not the bellwether of the UK economy because it's stuffed full of international stocks, if you like. They're mainly dollar orientated rather than sterling orientated, but a lower sterling does help the FTSE. We also have seen the fact that because they're energy firms and mining companies that both are doing very well at the moment, the FTSE 100, the UK 100 is actually doing very well, benefiting from its construction. Now, if we actually look away from that, and look at the reality of what the domestic stocks are doing, so that's the FTSE 250 and the 350, it's had a rough year. I mean, there's no two ways about it. The local economy, has been reflected in the actual heavy selling of UK domestic stocks. So don't look at the FTSE 100 or the UK 100 when you're looking at how the UK is getting on. It lies beyond that, because these are the companies that are actually active within the UK and are exposed to UK weakness. And so this is why we've seen this breakdown between the two different stock indices here. And it's important to understand your sectors here. So in August, we saw 15% of global fund managers were underweight of UK equities, up from only 4% in July. This is a big statement of international investors walking away from the UK, and they don't come back in a hurry. So I think this massive debt pile, this spending that we're going to get from the UK government, plus higher yields, which means the financing costs of that debt are going to become very expensive and difficult to deal with. I think international investors are looking elsewhere to put their monies to good work. And at the moment, that is hitting sterling even further. So looking at sterling, let's have a look at the short term first. Next week's a big week for sterling and the UK, of course. You've got to have your economic calendar with you. We've got some big data points ahead. We've got the FOMC meeting on the 21st of September. We've got the Bank of England meeting the day after it. So a lot going on there. The Bank of England, it's more than 50 basis points are priced. But if the FOMC are going to go 75 basis points, the ECB's already done the same. Could the Bank of England do 75 basis points? What if the Fed actually surprises everybody and does 100 basis points? I think while some of that is priced, I think that's a step too far for the Fed at the moment. I think we could see 75 and 75 September and October. But the point is that the Bank of England doesn't want to be left behind here, because otherwise sterling, which you can see on the left here, is in very real danger of getting hit again. Now, a weak sterling will exacerbate or fan the flames of inflation. So again, we've tried to get up to this 38% retracement level at 115.90. You can see on the chart here on the left. But if we break 114, there really isn't much support below that on the charts. If we look at a longer dated chart, if we look at the daily or weeklies. So if only at 50 basis points is done by the Bank of England next week, there's a danger that we could actually see lower sterling against the dollar. So they may need to be more aggressive and go 75 basis points. But what impact does that then have on an already weak economy? This is the struggle the Bank of England has to sort of try and deal with. And it's not easy. This is like a stagflationary phase that we're in. And we need to watch what this does to sterling. So is more volatility likely in sterling? Absolutely. So, I do think that the Bank of England will get rates higher. The question is how quickly. Other central banks are certainly front loading their rate hikes. Is it time for the Bank of England to do more than just 50 basis points with what's going on around them? This is the big question for next week, and it's a big question for sterling as well going forwards.